Happy Friday, folks. It's Shayan with Integrity Home Mortgage, back with your rates rundown for June 5th, 2026. Well, it looks like two consecutive weeks of improvement in mortgage rates is all we could muster. The Iran conflict delivered its now customary midweek whipsaw. The sequence of events kind of went like this: an early week ceasefire breakdown headline sent oil prices and mortgage rates higher on Monday. A recovery later in the week reversed most of that move as diplomatic efforts regained some momentum. And then the week's now closing with negotiations kind of in an ambiguous state, but investors' focus turning towards other headlines. And those headlines were about labor markets. But before we get into that, let's have a look at our benchmarks. As I mentioned earlier, after 2 weeks of improvements in rates, we have officially bucked that trend. 10-year Treasury yields are higher by 8 basis points to 4.52%, and 30-year fixed mortgage rate is better by 11 basis points to around 6.69%, so getting dangerously close to that 675 that we were at just a couple weeks ago. You'll recall we were flying high at the end of last week, testing the lows and rates on renewed hopes around peace talks again. And then disappointment set in and rates sold off again. And the again part, it's what's throwing a lot of folks for a bit of a loop. There have been so many head fakes at this point, you'd figure markets would have learned their lesson and not react to every headline. But here we are. And that's generally being driven by a persistent underlying belief that a peace deal will, in fact, be reached. That belief stems from the idea that midterm elections are less than 6 months out. High flying inflation and high energy prices are not good for incumbents, and it'll take some time before a peace deal resolves those issues. So the administration should be incentivized to find a solution sooner rather than later, and investors do not want to miss out on that trade. And that's what's keeping markets engaged and reactive to headlines. But the punchline this week really is about jobs, and that's what's got us going out at our worst levels of the week. Jobless claims, they've been on a upward trajectory for the past 6 months or so, but they still remain close to historical lows. We've also saw the highest job openings we've had in a year and a half, and the lowest level of quits for since the COVID era. So that's reflecting a kind of low hire, low fire environment, which is providing some stability to both employment levels as well as wages. All this culminated, of course, in this morning's blowout payrolls report, which blew a hole in bond markets and in our hopes for a further improvement in mortgage rates. This was an unambiguously positive report. The economy added 172,000 new jobs, which far exceeded the expectations of about 85,000. Last month's number was revised higher, and the unemployment rate stayed put at 4.3%. Kevin Warsh's first meeting as Fed chair is less than 2 weeks away, and we're going to talk about that more next week because that's worth going into it in a bit more depth. But we now have a solid trend of increasing inflation and stable employment, which basically makes it impossible to justify a cut in rates. Bond markets have priced this in fully. Zero cuts in 2026 is the consensus, and the probability of a hike has moved meaningfully higher just since the release of payrolls this morning. So, barring a dramatic deterioration in growth or a sharp decline in energy prices from a deal with Iran in the coming weeks or months, rates should remain right here in this current range. So, the end of it all is the higher for longer theme is well entrenched, and it's a good bet that the Fed's next move, whenever it comes, is going to be a hike. That's all I got for you this week, folks. We'll see you next time. Have a great weekend.